Hello, welcome to our third quarter 2024 investment review and market outlook video. We're going to run through, as always, a bunch of slides here. And if you have any questions or want to talk a little bit more, we'll be setting up meetings here for the fourth quarter soon. And as always, you can send an email or schedule a call directly with us. So let's jump right in. There's a lot that happened so far this year, and especially here in the third quarter. So the topics that we want to cover today, we're going to start with just investment performance. Then we're going to talk about the biggest news really of the last couple months, which is the Fed has officially started lowering rates, and want to talk about what that actually means. Then, of course, looking ahead, we've got a lot of questions from clients. Both sides of the political aisle. What does that mean that we have a big election coming up? I know it's top of mind for everybody. Then we've got a few other headlines that I just wanted to highlight, touch on. And then the last two, we'll see how this goes. I have become increasingly frustrated with the things that I see from market commentators, and just want to highlight one actually in particular and talk about just the fact that fear sells, and it sells so that you buy something, not because it's actually true or something you should be worried about. So we're going to talk about that a little bit. And then I've got this question a lot from clients recently. The market's up a lot. Is it overpriced? And should we be worried? Should we pare back some of our investments in stocks? So we're going to touch on that and really talk about reasons to be optimistic, kind of the opposite of what that fear sells will be. So jumping straight into performance, I'm just going to read from top to bottom. This is through September 30th of this year. So full 3 months, January 1st to September 30th. Gold is up the most from what's in client portfolios, up almost 28% for the year. Then we have the Vanguard Total Stock Market Index as just a proxy for what the market's done. That's in yellow. That's U.S. stocks up about 20.5%, 20.6%. VT is total international stocks. So that's up 17.8. Then we have specifically pulling out emerging market stocks up 17, and bonds are up about 4.5. Now, these have changed a little bit. Stocks are up a little bit more since this date, and bonds are down slightly in the last 2 weeks. But overall, I think this is pretty consistent with where things have been. A lot of that you can see. It's actually pretty consistent over time. Each quarter, we just have this nice steady mark up. One thing I want to point out, we're going to talk about this when we get to the other headlines later, just that international stocks really caught up, especially emerging markets, in the last month or so to the U.S. stock market. There was a big difference at the beginning of September that has that gap has closed significantly. So we're going to talk about why that actually has happened and what that means going forward here in a minute. But it's been really a great year for so far this year for but just about anything that you invest in. And obviously, taking on a little bit more risk, you were rewarded so far this year. That's what we expect in up markets and bull markets. So, getting right to the Fed, and the Fed did cut short-term rates by 50 basis points earlier. So that's 0.5%. And so we looked back and shout out to Fiducian Advisors, who helps us with some research and putting together client portfolios. They put this chart together, and this is just looking historically what has happened when the Fed starts cutting rates. Where does it end? And you can see that it tends to go quite a bit lower. The only time it really didn't dip too much was back in 1995, that yellow-orange line that we have. And actually, I think there's a lot of similarities between 95 and now. If we're going to pick any of these, most of these were done in a response to a major crisis, something big that happened, and now we have to react and protect the market. In 1995, Fed was trying to deal with inflation coming down, didn't want to have real interest rates get too high, and so just making some tweaks. This wasn't an emergency situation, and so that's probably a more likely one. Part of the reason I say that as well is we can't go down 6% because Fed funds rate wasn't even at 6% when they started cutting. So that 600 basis points or 6% of cumulative cuts that have happened historically, hopefully actually doesn't happen this time, because that would mean we go negative, and that would really mean we're in a really bad recession. So over time, this does seem to last quite a while, where you have a rate cutting cycle. And so we don't know what the next 18 months looks like, next 22 months, if we follow the exact average cutting cycle. But these tend to not just be short-term moves. So let's look at performance after the first rate cut of cycle. So looking at the last several, back to 1980, and then you see all the way to 2019 when the cuts. This is just looking at S&P 500, so large cap U.S. stocks, Russell 2000 is small cap stocks, the aggregate bond, that's just bond returns, and then what did the dollar do over that period of time, a year after the first cut. And you can see, just look at the average right there, pretty good for stocks, a little bit lower than the long-term average, but still, I'll take 8.8%. And then bonds actually historically have outperformed stocks as rates start to fall. That makes a lot of sense. When you own a bond and rates start to go down, you still have if you have a fixed rate bond, you're still earning the same interest that you would have, but now the market is willing to pay more for it because they can't get that same interest rate for the same price as they did before. So tends to be really great for bonds, but really overall, the Fed cutting rates is not a reason alone, not a reason to get really concerned or want to get out of stocks or anything like that. So let's move to the election. And the most important thing that I'll just say is, historically, the election, whether it's president, Congress, does not matter for stocks. So if we look at this chart, this is showing when a Democrat is president versus Republican. And you can see over time that staying invested is the best course of action. Actually, if you go back, if you were to just invest when a Democrat is president, or just invest when a Republican into stocks, you would have 10 times less money than if you just stayed invested that entire time. So it doesn't actually matter from a pure stock market perspective. Um, stock is Stock returns are about companies making money. Yes, things like tax rates matter and will matter on the margins, but when it comes to investing, stay invested is the most important thing. So what does that mean? No matter what happens between now and election day, and then after that, we are not in any way going to use that to change allocations moving forward, and you really should put that out of your mind. Doesn't mean the election doesn't matter. It just means it doesn't really matter for you as a stock market investor. So I want to touch on a few other headlines, just things that have happened recently that I want to shed some light on. So the biggest news, both actually this past weekend, so I'm recording this on October 15th, biggest news this past weekend, and then also goes back to the end of September, a few different announcements from out of China, just talking about a large amount of stimulus package. I know a lot of U.S. investors don't know what's going on in China, don't know about the economy, but there is a big risk, and has been for a while, of recession, um, lots of real estate related debt issues, and just people really struggling compared to what we're seeing here in the U.S. And so China announced just quite a bit of stimulus that would happen. Lots of different things: direct money, forgiving loans, saving some corporations, just a whole lot of things. And you've seen since then the stock market in China has gone up quite a bit. So Chinese stock market is up, if you look at this chart here on the right, about 25% since that original announcement. And no one, well, except for insiders, knew this was coming at all. It just kind of came out of nowhere and surprised investors. That's why you've seen this big pop, because there's a expectation that this is going to reward investors in China to have all this stimulus. That being said, although it's more favorable now, that's why the market's up. We are not changing our allocation to emerging markets. So your emerging market stocks benefited from this pop in China in the Chinese stock market. You've earned more money. That's what kind of closed that gap. When you look at emerging markets, going back a couple slides on our performance, was really this pop that we had here specifically to China. But this doesn't change our outlook going forward. There's still a long road ahead in China. The market's already adjusted, so now's not a time to go and do anything else and over adjust even further. The prices reflect the headlines, and that's already there. Then I want to touch on something now, as someone who is an economic major. I enjoy talking about the overall economy and what's happening. Um, so this might be a little nerdy a little bit, but I think it's actually really important to just highlight how this works. So every month there is key data released. So whether it's inflation data, unemployment statistics, um, quite a anything you can think of. And one big one that comes out is talking about GDP and then also what the net income rate is. And those really should line up and where's money going and how's that being spent and all these things. So back in the I think this is about a month ago, there's a revision to previous data. So you have data that comes out based on the information that we have on what payrolls look like, payroll numbers, wages, tax receipts, everything that is currently paid out and then recorded. And then as months and quarters and years go on, there's revisions to this data. And they go back and they look and say, okay, now that we have better information, people have filed their tax returns and we went back and looked and made sure we didn't double count something here or there. They'll make a revision and say, okay, well, we used the information we had at the time, but now we have to fix it, and here's what it actually looks like. And so there was a very major revision that went back, looking over the last 5 years, that just came out. That if we think back a couple years ago, so last year, actually, I think it was 22, there was a recession. It was 2 quarters in a row of negative GDP growth, which means the economy is contracting for 2 quarters in a row. Well, one thing that happened with this new revision is that actually went away. So GDP actually was up for, I believe, is the second quarter, and that means we weren't at the time in a recession based on the data. That's a little bit of a nuanced definition anyway. But more important that I think is if you look over the last couple of years, there was a conversation that the average US consumer was tapped out. We had savings rates at lower levels than they were pre pandemic. There was a concern that your people are starting to use more credit, and that would be leading to a recession. And actually, that accounted for there was essentially a difference between the GDP, so the output, and the income that was reported of $770 billion, which is just a huge number. And now that's been revised, and now the gap is only about 200 billion, so it's a lot better. But all that gap came not from lowering the GDP, but actually showing that people earned about $560 billion more than was previously reported. And what that means is the data that people were worried about in 21, 22, 23 of the US consumer being tapped out has now been revised, that we're just on the same historical path that we were before. And that I think is something that a lot of people are going to miss. And you're going to think back and remember, oh, I was really worried in 2022. The market was down. We're worried about a recession. Um, the data was better than we thought at the time. And so that's also important looking forward, because whenever you see, oh, unemployment ticked up a little bit this quarter or this month, or GDP didn't go up as much as expected. Yes, that may be true, but it also is important to keep everything in perspective, and there probably will be revisions down the road. And so that leads to actually another data point that I want to talk about very briefly here, and that's the SOM rule. So back in September, the SOM rule was triggered. So this is somebody she used to be at the Federal Reserve and was tasked with creating a rule or creating a measurement that the Fed could use looking ahead to make changes to their policy. And what she determined was, if you look historically, when you have a rapid rise above historical norms of unemployment rate. So more people losing their jobs at a faster rate than you would normally expect in a normal market. That when that happens over a certain period of time, they, there's a recession on the horizon. And when this was created, and she determined it was 100% successful. If you had done this, if you looked historically based on her rule, once it's triggered, the Fed should act to avoid a recession. That was the argument. Now, this was triggered at the beginning of September, and it was a big talking point. She went on a big tour, but one thing that she even said is, I don't trust my rule right now. And so we're going to talk about fear sells. A lot of people said, oh, look, recession's on the horizon. We've got a big problem. The creator of the rule even said the unemployment rate is changing not so much because people are losing their jobs, but the way that it's calculated. So when we are comparing unemployment rate, you have COVID shutdowns are still messing up the data when you look at historical movements. And then more importantly, in the short term, is we have had a large amount so far this year, a large amount or a large increase in immigration, both legal and illegal immigration. And that what that does is create a larger labor force. So even if there are no people that lose their job, the unemployment rate goes up because you have a higher denominator, a bigger denominator of the number of people looking for jobs. And so those nuances in the way that unemployment rate is calculated, even the creator of the Psalm rule said, I don't believe it and don't think we should follow it. But again, as we go to the next slide, fear sells, and a lot of people were worried. And so my a little bit tongue in cheek, but fear sells. If you get scared, turn off the news. That is probably good advice for not just the market, but a lot of different things. From most measurements, most actual real measurements. It's there are things to be worried about, but there's a lot of reasons to be optimistic. Overall, now's a better time to be alive than most other times in the history of the world, and we need to keep that in perspective. But I actually want to call out a specific article because it's things like this that just make me really angry, because it is preying on our human innate nature to pay attention to patterns and to see patterns that don't exist when they're not there. And so this was written and released back on, let me find the date here, on October 9th. So this was just last week. And the reason that's relevant is right before the great financial crisis, October 9th, 2007, was the peak of the market. And on October 9th, 2024, the market peaked again. Now, this is one of many different times this year that the market has hit an all-time high. Also, I will add, we expect in most years the market at some point will hit an all-time high. That's how the stock market works. But this article said exactly 17 years ago today, the S&P 500 closed at a fresh high and then didn't hit that high water market again. There are a lot of similarities between October 2007 and October 2024, and highlighted things like the Fed begins easing. You've got an all-time high in the S&P 500. The yield curve that was previously uninverted, and so went back to a more normal piece. And each of the things that are said makes sense on the surface, and each data point seems really relevant until you actually dive a little bit deeper and look at what is being said. And the point that I'm making with this is the author of this article has a sales pitch at the end, which is there are reasons to be concerned. He's essentially saying it's 2007 all over again. We are going to have a 60% drop in stocks. That's the implication. And of course, his sales pitch at the end is to say, but if you sign up here, I will help you invest so you don't have to worry about it. Of course, that's the way that it is. That is very direct. But there are more subtle things. If you are watching CNBC and there's somebody on a talking head talking about we've got a major problem, the only reason you go on there is because you have something to sell, whether you are directly selling or you want people to know your name, so you follow and you get followers and you get paid by ads or whatever the thing is. And so because we are primed to identify, pay attention to patterns, even if they're irrelevant, we have to be careful and be aware of, if you feel that emotional reaction to reading something, make sure it's logical, not just emotional. And so I wanted to take this and let's spin it the other way. There are a lot of reasons to be optimistic about the market moving forward. And so we're just going to highlight some of those. So the first is really directly from a client question that I had in the last month, which is the market's up a lot. Isn't it overpriced? And so I went back and I looked at the earnings per share growth versus the S&P 500, so SPY, total return. And over time, you can see that year over year, earnings and the return of the investments tend to move in line. There are some years like 2015 that didn't happen. Some years like 2020 that didn't happen. And there's reasons for that. But as we look overall, since COVID, let's use that example. Since COVID, earnings are up a higher percentage than the S&P 500 is up, which means that actually just looking at earnings per share of the company, so the actual profits of the companies, it is cheaper to buy U.S. stocks now than it was right before COVID, which I think is crazy for most people, but most people see the return number, that blue bar that we have there, and aren't actually looking under the surface at what earnings are, that companies are making more money. And so there's another way to highlight this. U.S. corporations after-tax, adjusted after-tax profits for the 1940s to 1990s were 5 to 8%. They kind of stayed in that range, 5 to 8% of GDP, which means the whole economy, at the end of the day, you've got 5 to 8% earnings profit that's actually made. Today, that is 11%. So companies are getting better at making money. And we don't have to get into the politics of that and is that a good or a bad thing. But as an investor, your job of investing in stocks is to buy companies that are going to make money. If you don't buy companies that are going to make money, your stocks will not go up. And so this is a reason, it's another reason why the market's up a lot, but there's a reason it should be. I want to buy companies that make more money. If they make more money, you're willing to pay a little bit more for it. And so this is an important thing to keep in perspective. Another thing that kind of another piece to this is, I think people get concerned when the stock market is up 20% a year. You see these numbers, they're pretty big. I want to point out almost none of these are right around a 10%, 12% long-term average. And that's important. So what this chart is looking at is going back to 1926 and showing you the long-term average of U.S. stocks over that period of time is 12.2% up. So on average per year, you're going to earn 12.2%. However, you have almost no years that you end up having returns that are within 5% of that long-term average. Another way to say that is this: you are more likely to earn 20% or more than you are to earn around 12% a year. So every 3 to 4 years, we expect you're going to lose money in stocks. Historically, that's what happens. The other years, we would expect that probably 2 out of the 4, you're going to make more than 20%, and then you'll have another one in there. That is the long-term average. That is what happens in different markets, different economies, different inflation, different political regimes, all sorts of different environments. That's what we would expect. So it's actually normal that we have the last couple of years that we had. So I'm going to go back one slide because I want to point out the returns here. Just looking at the blue. So 22, 23, and then 24 so far this year. So this is not, projecting out forward. We lost 18% in 22, up 26% in 23, up 22% in 24. You know what that averages out to be? Right around the long-term average of 12%. And none of those were in line with where with the normal long-term average. So this is the way markets work. We expect to have really great years and some bad years and some really great years and some bad years. Then you wake up 5, 10, 20 years later and you're earning 10, 12% a year. That's what we expect to happen. And so as we think about, just kind of close this out, there are a lot of reasons to be optimistic, but we're not going to be blindly optimistic. We want to make sure that you have a portfolio that you can handle, that when we have those years that markets are down, you don't panic, we don't sell, you don't have your lifestyle changed. That's why with stocks, in our mind, stocks are for 10 years or longer, so that you can let things work itself out. You can get those long-term returns and not sell when things are bad. But another reason to diversify, and I'm just going to read this quote on the screen here, is the reasons to diversify are more about what you don't expect rather than what you do. So the market's already priced in Middle East conflict. The market's already priced in the possibility of Russia-Ukraine war continuing on and getting worse. It's already priced in the possibility of a China-Taiwan escalation. It's already priced in gridlock, after the election for whatever reason. All these things are priced in. If you look historically, most of the times that we have a major drop, they're exogenous shocks that nobody saw coming. It's things like COVID. It's the great financial crisis not being confined just to housing, but turning into an actual financial crisis that was global in scale and had multiple things happen. You had the tech bubble burst, which maybe was seen, but not seen the way that it would flow through the whole economy. That's what the major drops are. And that's why we diversify, because by definition, if we don't know, what we don't know, we can't protect against it. And so we want to make sure that you're well diversified. You have stocks, both U.S. and international. You have bonds, you have gold, you have other commodities, you have some energy stocks. We have a lot of different things in the portfolio intentionally so that you can remain invested and capture those returns without having your lifestyle negatively impacted. So hopefully there's some good stuff here. If you have anything you want to talk about, want me to send you some more information, send you some charts, just reach out and let me know. But enjoy the rest of the year.